Welcome back to EDS, and in this video I'm going to show you a simple formula that generates consistent returns every day, every week, month and year. Now, in order to get a consistent return, you need to have a high probability of success, and generally in the markets you don't get anything for free. So in order to get a high probability of success, you typically give up your returns and end up making smaller returns. However, with this formula, we're gonna figure out a workaround. It's a little hack that allows you to get high returns on your capital and high probabilities of success, and that's going to generate you consistent returns every day, week, month and year. So the first thing you want to do is open up a watch list that a watch list of futures that has options contracts available to trade on them. If your broker doesn't natively show you a default watch list, just take note of these ticker symbols here and make your own custom watch list. Now, we're going to be using options contracts. We're specifically going to be writing options contracts, which is going to give us a high probability of success, and then we're going to be writing those contracts on futures contracts. And using futures allows us to utilize span margin, and span margin allows us to be capital efficient, and that is what is going to give us or allow us to make high returns on capital, ticking both boxes. So once you've got a watch list open that looks like this, you want to order everything from high to low IV rank. And the reason for this is because volatility contracts in the market most of the time, and writing options contracts basically means that you are short the contracts. And when you are short, you want to sell high, buy low. And when volatility is high, option prices are high. So we want to sell contracts and go short the contracts when volatility is high and play the contraction. And the reason why this works is because volatility is mean reverting. So generally speaking, you want to stick to underlyings that have an IV rank of at least 30. Okay, we've got the wheat futures here with 31.4. So anything above this. And anything over 50 is considered very high. So over 30 is high, over 50 is very high. I generally like to be anywhere, in the mid to high range. I don't like to be too high or too low. And if you have a smaller account, you probably want to stick to currencies such as the Aussie dollar, the Canadian dollar, Japanese yen, etc., British pound, so on and so forth. The contract multipliers on these products are quite big. They're in the hundreds of thousands. So do keep in mind that these are big products, so you do need to know how to manage risk properly. So without further ado, once you have picked your underlying of choice, I'm just going to go with the euro here, and this will be a good example for smaller accounts as well. It has an IV rank of 62.4, an absolute IV level of 8.1%. Now you might be thinking this is a low IV. Well, currencies don't actually move too much. So an IV of 8.1 lines up with a 62.4 IV rank. Now, for equities where you don't use span margin, you would basically not be able to collect much premium. Okay, you'd get a high probability of success, but you wouldn't be able to collect much premium. But span margin on futures takes into account the IV. So the lower the IV, the less your buying power requirement will be. So this is why currencies typically will work well with smaller accounts, and I'm going to show you what to do. So once you've got your underlying selected, go over to where you can see a list of expiration dates, option expiration dates specifically for that particular product, for that underlying. And as you can see here on the left, we have a list of option expiration dates, and then next to it we have the corresponding futures contract. Now, both options and futures have expiration dates, but you don't need to worry too much about which futures contract you need to pick, because any good broker will automatically line the information up for you here. So for example, we have February 7th, March 7th option expiration dates that line up with the H5 futures contract. And then if you go further on to later dates on the option side of things, you go to the M5 contracts and the U5 contracts and so on and so forth. So you don't need to worry about which futures contract too much. You just need to focus on the options expiration dates. And the one that we want to pick needs to be between 30 and 60 days out in time. So we've got one here at 39 days. March 7th. So we're going to open up that expiration date, and now we are presented with the options chain. And very quickly, I'll show you what's going on here. On the left, we've got calls. On the right, we've got puts. We've got this horizontal line, orange line, going through the middle. That shows us where the current price of the underlying is with respect to the strikes that are going from top to bottom here in the middle. And then we have this vertical orange line that shows us what the expected move is of the underlying over the next 39 days. So we are going to be capital efficient, which is going to allow us to get a high return on capital because we're using futures which uses span margin. So now we need to ensure we get a high probability of success so that we can get consistent profits. So when we are short the contracts, when we write options contracts, what that means for us in the real world is that we want price to stay away from those contracts. We don't want price to go near those contracts. We want price to stay away, and we definitely don't want price to breach those contracts and go further past them. So what we're going to do is we're going to use 3 bits of information. So we have the expected move, we have the standard deviation levels that are displayed with these dotted blue lines, and then we also have our deltas, positive deltas on the call side, negative deltas on the put side. So if we want price to stay away from our contracts and we know what the expected move is, we simply just want to sell contracts outside of the expected move. And if your broker doesn't display it visually here, your expected move is also going to be up here in the top right. Every broker should pretty much show you what the expected move is based on what implied volatility is, and that does change based on the expiration date. So just make sure you are looking at the right expected move for the expiration date that you are looking at trading. So we want to be outside of this expected move, and the further out we go, the higher our probability of success will be, but the less premium that we will also collect. So a happy balance, in my opinion, is to be around the 1 standard deviation level, and that both of these things, will typically line up with the third point of confluence, which is delta, and you want to be between about 15 and 20 delta. So if we start with delta, we've got an 18 delta here on the call side at the 1.075 strike, and we have a 16 delta on the put side at a 1.025 strike. And if you have a look here at the bottom, we are pretty much delta neutral, negative 0.02 deltas, which is delta neutral enough. So what you'll notice is that our contracts are sitting outside of the expected move. They're in and around the 1 standard deviation level, and they land between 15 and 20 deltas. Okay, and so what's happening here? So we've created a range for ourselves, and we want price to be within this range at the point of expiration, which will be in 39 days time. And what's the likelihood of this happening? Well, it's 71%. We have our pop here in the bottom left, which is probability of profit, and that means that shows us what our probability is of making at least 1 penny on this trade. Okay, technically, it's based on our break-evens, which is displayed by this green bar here. So if price is anywhere within this green bar, we'd make at least break-even or a penny. That's where our pop comes from. Now, what if we don't want to wait all the way till expiration? 71% is very high. Don't get me wrong, anything over 50% is considered a high probability trade. So straight away, if we waited till expiration, we've got a 71% of this trade working out. But if we didn't want to wait till expiration and we wanted to get out, say 50% of max profit, well, we have this P50 number here, which isn't displayed for futures. However, your P50 will typically be 10 to 15% higher than your pop. So we'll be looking at a P50 of between about 80 and 85, 86%. So all in all, depending on how long you want to hold this trade, we've got a probability of success of between 70 and 85%. Okay, very, very high probabilities of success. If you wanted to get out at, say, 25% of max profit, it'd be even higher. But we're just going to stick with P50 for now. And that is before taking into account that implied volatility is generally overstated compared to actual volatility. So in reality, your probabilities of success will actually be slightly higher than between 70 and 85%. But already, I'm sure you can see where this is going. This is how you can generate consistent returns, by getting consistent wins. Okay. Now, how much money can we actually make on this? What's the return? So this is our our mid price here, this is what we would try and get filled at, 0.005. Now you might be thinking that's a bit of a weird number, but remember, if you remember earlier in the video, I did mention that these futures products have big contract multipliers in the hundreds of thousands, but you don't need to worry about that because your broker will automatically calculate it for you. So once this number has been multiplied out by the multiplier, we end up with this max profit figure here, $625. So this is in dollar terms what you would collect in premium upfront if this would get added to your cash balance automatically as soon as your order gets filled. So we would collect $625 upfront on this position. Our broker is going to require just under 1.4k in buying power to open this position. So already you can see we are getting a very high return on capital, a little bit under 50% return here, and that's in 39 days. That's not over the year, that's in 39 days, and we've got a probability of this trade working out in a favor of between 70 and 85%. That is also before taking into account any adjustments that we make to rebalance deltas and things like that if a position does move against us. That also doesn't take into account rolling out in time, etc., things like that. So in actual reality, our probabilities of success would be far higher if you know how to make adjustments and manage risk properly, and we're already getting a very high return on capital. We've also got this theta number here, which is $21.49. Well, it's just gone up now, $21.50. That's how much money we would be making on a daily basis in theta decay, assuming all stays equal to what it is now. That theta number will increase and become more aggressive as we get closer to expiration. But what if you wanted a higher return on capital? Say if these probabilities of success, as high as they are, let's say if you were happy to sacrifice a couple of percent on your probabilities of success to get a higher return. How do we do that? Well, we just be more aggressive on our deltas. So let's say if we go to the next strike closer to the money, which is at the 24 delta mark, we can then go to the 25 delta strike here, which is or the 25 delta contract. We skip the 20 delta because 25 is close to 24. It just helps us be more delta neutral on the position. So if we were to go to 24, 25 delta instead of a 16 to 18, 19 delta, well, now we're going to collect $975 up front, and our broker is going to require just under 1.5k in buying power. So as you can see now, we have an even higher return on capital, quite a lot higher than what it was before, even though what it was before was still quite high. Now, in order to get this, we have had to give up a little bit of our probability of success. So our POP is still 64%, and our P50 would still be in and around 80%, 75 to 80%. So we've given up about 5% on our probability of success, but we've massively boosted our return on capital. The more risk you take, the higher your P&L will be. But of course, there is more risk, so you do need to manage that risk more effectively. And our theta decay has also increased as well. So with that in mind, you do need to know how much buying power you should be allocating to your positions. And in order to figure that out, we've created a free position sizing template that's available for everyone to get a copy of. The link is in the description. Just click the button and it will take you over to the spreadsheet. And the way it works is you enter in the size of your portfolio. So say if you have a $25,000 account, you can then enter in whatever the current VIX level is below it. Say if it's 32.1, and then everything below will be automatically calculated for you. It will tell you the maximum amount of buying power to allocate to any defined risk position, undefined risk position, how much of your portfolio you should be allocating to short premium in general, the minimum amount of your portfolio that you should be allocating to undefined risk trades. What we went over today was an example of an undefined risk trade. And as long as you follow this, over the long run, you'll be absolutely fine. If you do have a small account, you may need to be slightly more aggressive on these numbers, but try and stick to it as best as you can. And if you have a large account, you definitely should not be violating these guidelines here. And over the long run, you'll be fine. If you would like to learn in more detail about what we do and how we do it, again, link will be in the description. This time, click on EDS Premium. Get yourself signed up. Inside, you will have access to our portfolio that will allow you to see the positions that we're placing, how we manage risk, how we make adjustments, all in real time. There's also a full course, so no prior knowledge is required. We will teach you everything that you need to know from start to finish. It is a private community, so if you do get stuck, you can speak with myself directly or with other like-minded individuals. And there's a 100% money-back guarantee. So once you study the full course, follow some of our trades, after 6 months, if you are not profitable, we will work with you for free until you are, or you can request a full refund. So it's completely risk-free. Right now, it is $9.99 a month to join. The price will be increasing. However, once you're in, the price is locked in for you, and you won't have to worry about any future price increases. So the earlier you get in, the more you are rewarded. And the aim of EDS Premium is to teach you the skill. We do not want to keep you dependent on us. We want to give you the skill, give you the knowledge, and once you have that, it's something that you can take with you for the rest of your life. Nobody can ever take it away from you. And we aim to get you to that point where you are completely self-sufficient within 6 to 12 months. You are always welcome to stay and be a part of the community, but 6 to 12 months, you should be good to go. So with that being said, I will see you guys on the inside.